Thanks for tuning into Talking Point. I'm your host, Neeraj Shah. One of the recent tweets of our guest today said that there is clear identification of India as a preferred as well as tactical market where allocation needs to be higher from global funds. Markets, he says, will go strongly into the general election next year. Fasten your seat belts. For bulls, this is music to the ears. The question to our guest is whether the party will stay well into the next 12 months, which I believe he does believe, and what are the hindrances or risks to something like this. Ravi Dharamshi of ValueQuest Johnson right now. Its funds have done remarkably well, so he must be a happy man. Ravi, good having you. Thanks for taking the time out.
It's good pleasure to be here.
Yep, the pleasure is entirely ours. Ravi, your tweet kind of very easily depicts what you feel about the markets. Um, what gives you this optimism? Is it a combination of growth plus flows um, and other? I mean, just lay down the factors for us. Just tell us how you look at the equities through your prism.
So, Neeraj, of course, we've been bullish for the past 15, 18 months as well, but the markets have been kind of consolidating. But at our end also, anecdotally, we have been witnessing a lot of inflows from foreign funds. And on the recent trip that I went to Middle East and Southeast Asia, I interacted with a lot of long pension funds, endowment funds, sovereigns, family offices, and I got a consistent feedback from everywhere. Let's not talk about India. Uh, India is, and I say it in a very positive way, that they understand the India story completely. There is no need for us to sell India, if you know what I mean. So we have a salesman in charge of India, and they have done a wonderful job of selling India. All we need to do is maybe sell a story or pick themes within that where we feel money is to be made over the next 3, 5, 10 year horizon. So consistently, all the sovereigns who you most of the allocation to India comes either through market fund or through direct India exposure. There are very few funds that have direct India exposure. Those that do not have are considering having a direct exposure. Those who have through emerging market fund are considering increasing. Those who used to treat India as a tactical market are considering making it a preferred market. So you can see that there is a consistent upgrade of Indian market in the minds of the long only and active funds are really, really wanting to participate. And they feel last year, because of many reasons, of course, they had to kind of withdraw a little bit, but that was not their preferred mode of action. It was more because the world was entering a phase of uncertainty. India relatively had become very, very expensive. So it was easier decision for them. And in their portfolios as well, India had become a big overweight. So they reduced. And for the first time ever, a $40 billion outflow out of India. And we barely had a 15-17% correction at the index level, and maybe a 20% kind of a correction at the overall market cap level. So that tells you that India has become very, very resilient. And I'm talking about Indian capital markets over here, but that same resiliency is there in the Indian economy as well, and it is reflecting in the way people are becoming confident about India as a destination for good.
Ravi, did this important point, did the depth of the Indian markets in the way Indian markets absorbed the kind of selling that happened, before March for a period of 6, 7, 8, 9 months, did that come up recurringly in conversations? Because I'm sure it's something that surprised most people, including us sitting out here as well.
Yes, Neeraj, and I would add $40 billion is only on the listed side. The unlisted, the private equity space had another $20-25 billion kind of exits. And in a world where there is a funding sector going on, they are more than happy that they could actually get some exit in India, and those were profitable exits. So that has definitely led to India standing very favorably in their eyes. And as I said, that such a large outflow and the depth of the market was so good that people are waiting for a markets to become much cheaper, but unfortunately, that's not going to happen because Indian story has remained resilient and incrementally from this point on as well. Whether it is crude, whether it is a currency which is very stable, current account deficit, the story is only getting better. Inflation is under control. RBI was the first one to pause. Fed is probably going to pause in the next upcoming meeting. So I think India has charted its own course. Indian story stands out very, very clearly in the minds of the investors. And so it is difficult for us to get the overall opportunity much cheaper than where it was already maybe 2-3 months earlier. In the month of March, I think we were at a point where it was reasonable. From a 1 year, 2 year forward point of view, we had come to a very, very reasonable level. So money is starting to flow. As we have witnessed, the month of May had almost $4-5 billion kind of an inflow. So that is only the beginning. I think our ability to absorb capital has increased tremendously. $2.5 trillion market cap, I think we can easily have $100 billion. I won't be surprised if we have $100 billion net inflow year in a particular, anytime in the next 5 years. I mean, I would want to say it probably in the next 3 years, but in the next 5 years for sure.
Interesting, Ravi. So just wondering, did the question of Indian markets being able to absorb such high level of selling come up in your conversations when you met these global funds?
Yes, of course. I think it was the fact that we had a $40 billion exit in the liquid in the public markets and a $20-25 billion kind of an exit in the private market has done a world of good for the investors, especially when they could not get any kind of an exit, whether it was on the crypto or the US tech or other asset classes or bond market. So India actually was the loan market where they could actually book nice, healthy profits, and were able to do that pretty smoothly without much impact. So that definitely helped India's cause in terms of, I think India is ready to move from a $3-3.5 trillion market cap to maybe $5-5.5 trillion market cap over a period of 4-5 years. And that movement will happen obviously along with the growth in the GDP.
Yeah, and therefore, Ravi, sorry, we're starting on flows, and therefore I'm sticking to that, and then we'll come to the fundamentals as well as to how you see it. But do you reckon that large oodles of inflow could come into India over the course of the next 2, 3, 5 years? And what are are there any telltale risks that people think of when it comes to India? Did the election come into conversation at all?
No, so I think absolutely telltale signs that a lot of money will come in. And I think you are right. The two risks that we constantly keep hearing about, one is the election and second is valuations. These are the two things that scare people the most. However, I think on the election front, there is a lot of confidence, but people, before committing any kind of major FDI money, they really want to see the election pan out. But for the capital flows, I think the money is already beginning to come in, as we have witnessed in the month of May, where we had almost $5 billion come in. So I won't be surprised if we see a $100 billion kind of an inflow in a particular year in the next 3 to 5 years.
Oh, okay. Ravi, so you mentioned about the kind of flows that are coming into India. You are getting them as well. I would love to understand if you are comfortable putting that money to work, lock, stock, barrel, at the current juncture, at the current valuations that we are at, or are you also tactically waiting for select pockets to dip, even if the market at large does not show a meaningful correction?
We are actually more than willing to deploy the money. We have enough opportunities at hand. Stocks, companies, you see, market is actually quite discerning. It is not like the rally in the last 1.5 months has made the market very expensive, or that every stock has participated. Yes, it's been pretty broad-based rally. Maybe 300-400 stocks have rallied about between 20 and 40% kinds, but still enough juice. See, from the point of economic cycle, I think we are still in the early stages. What started off in the depths of COVID is now only going to accelerate going forward. But there is always a sector rotation attached to it. So there are, even at this point, we are seeing enough opportunities. So financial is one space where we have been overweight since the last 12, 15 months, and we continue to stay overweight. And now we are beginning to see opportunities emerge in the financials, but non-lending space. So whether it is the AMCs, whether it is the wealth managers, whether it is the market infra companies, they haven't gone anywhere for the past 2 years. In fact, some of them are down 30-40%, and some amount of sanity has come in terms of the earnings as well. So they're kind of linked to the market cycle. So the market cycle itself peaked out in October of 21, as whether it is from the point of view of trading activity or overall IPOs, and those activity will start again going forward. So I think some amount has already started, but I think it will gather momentum going forward. So even capital market linked plays will become attractive, are still attractive at this point. In fact, some of them are mid 15-16 multiple is not a very high valuation to give if you are looking at some of these companies. So without naming any, I think if we are a lot of inflows does come in, I think there are enough avenues to deploy those money as well.
Got it. Ravi, to your mind, what is, we'll first get the risk out of the way, then we'll come to the opportunities as well. We already made a small inkling into the opportunities, but I just understand. Globally, people are talking about elections and valuations. To your mind, is there something else that could disrupt the party?
So it's the fear of the unknown. Usually in the past, what has happened is that India ends up shooting itself in the foot. So what we are constantly, or what the investors are constantly worried about, is that we don't have something else dictating the policies other than what we have been focusing in until now. We need to follow capitalistic policies. We need to be focused on supply side reforms, and we need to provide just the right dosage of demand stimulus, and if not required, not provide any kind of a demand stimulus, and maintain fiscal discipline. If those things are managed, I think red carpet has been laid out across sectors for the investors to come in. So I believe that the pace is only going to gather even more momentum.
Okay. Now, I would love to understand, Ravi, how do you think about some of these pockets? And humor me a little bit here, but I was speaking to a steel tubes company which says that we won just one railway station. There are 1,250 in the offing. I was talking to a railway company which is saying that my book to bill is currently 10x, and there is scope for some more improvement because we're going international as well. The capital good companies talk about how 70% of the buildings of 2030 are not even built as yet, and therefore think of the quantum of uptick that will come into infrastructure and real estate, so on and so forth, and automation, etc. Now, my question to you is, when you are thinking about investing, do you look at some of these possibilities that companies could go to, and therefore, even if they are slightly expensive right now, let's go out and buy? Or are you looking at them currently from an FY24 valuation perspective?
So obviously, we have to look at the probabilities and not the possibilities. I would rather that I benefit from some of those possibilities panning out over my investment horizon, but I don't want to pay for them upfront for sure when I'm taking a bet. Having said that, stock that goes from 15 multiple to 20, or 20 to 25 to 30 starts looking expensive along its journey, and we have no clue where the end point is. So what you need to do is focus on the cycle. So whether it is from the railway capex cycle, defense capex cycle, overall capex cycle in India, renewables, I think a lot of this opportunity is definitely huge, and it is only beginning. So I don't want to pay 2 years, 3 years forward, but at the same time, I don't see a reason for the stocks to fall 50% just because they are trading expensive. I think as long as the companies continue to deliver on the numbers, the higher multiple are more likely to sustain rather than us witnessing a crash.
So what themes do you have the highest comfort on, Ravi? Again, what will turn out, as you said, nobody knows. But where is it that you find the highest comfort amongst pockets that might be a touch expensive if one looks at the TTM multiples, but where the opportunity size gives you the comfort?
Okay, we just spoke about those. I think one more thing that came out during our these roadshows is that India as a manufacturing destination is acceptance. So, and a new term that I came across, and not a new term, but a new application of that term. So, China plus one, we have been thinking from the point of view of supply chain shifting, on the ground companies shifting, and from that point of view. But what some of these fund managers told me is that in the capital market it is far easier. I can straight away take some money out of China and deploy into India.
Mm-hmm.
So the China plus one from capital markets point of view is already happening. From the on-ground economy point of view, it might take some time. Coming to the question that you asked about some of the opportunities that we are seeing, I think see there are what we try to do is identify a top-down thematic trend and then try and identify companies within that are best positioned to take advantage of that. So whether we have a company or a bet yet in that trend or no, but some of the trends that I believe are very, very strongly rooted on the ground and have lot more legs to go are defense. Yes, stocks have moved up. Defense is not an unknown story or not a new sector anymore. But I think there's a long way to go. We will have it's still a defense PSU sector. I think private sector will also emerge out of this. And this is a 5, 7, 10-year trend minimum, in my opinion. It could be beyond that also, but let's at this point of time just stick with the next 5, 7 years. And I say 5, 7 years is because one frigate, for example, if a shipbuilding company is building, it takes 7, 8 years to build that. And they already have the visibility of what kind of orders are coming up in the next 12 months, 18 months. Once the election result risk is out of the window, it will actually become very, very clear. The ordering and everything will become even more smooth, provided, of course, that the current dispensation continues even going forward. So at this point of time, you are carrying a little bit of risk because some of these sectors are heavily, if I can say, NDA government priorities. I am not so sure if there was a change in regime. There might be change in priorities as well, and some of the sectors might undergo some changes. But coming back to the sectors, defense is one, railways is a large opportunity. We have not seen this kind of investment happening. If you see in the last budget, the largest percentage and absolute increase in terms of capex has happened in the railway sector. And it is only the first year. So we are going to witness more and more money being spent, whether it is on wagons, whether it is on a signaling system, whether it is on all kinds of upgradation and modernization associated with railways. Third sector, which right now is undergoing a little bit of pain in the China plus one story, is the chemicals. However, I do strongly believe that chemical story is not over. We have not reached a stage where you can say, let's forget about the chemical story for now. These companies will become far, far bigger from here as well. But I think for the time being, I am a little neutral to underweight in the chemical sector. Then electronics manufacturing is one big space. The stocks have done tremendously well in the last 3 months. And I'm not saying that, I have no idea whether the stocks will go down or up from here. But at the same time, the opportunity size is really, really large. And we are going to witness the entire electronics ecosystem, starting with the assembly, moving on to the components, and eventually the entire products getting manufactured in India, whether it is an Apple iPhone or whether it is a Samsung. And that is going to open up big opportunities for some of the companies in India. And I think this trend is also a minimum decade, if not more. India will go from being the manufacturing is about 10% of the GDP, 10-11%. I think it will go to somewhere between 15 and 20% by the end of this decade. And I think that itself is the story, because these sectors sector itself will grow at 20-25%, and you will find companies in these sectors which are going to grow much faster than that. So that is a very, very, I say, a fertile space to look for opportunities with a 5-year point of view. See, because the stocks have run up, probably you have to extend your horizon or lower your expectation. But at the same time, the certainty of those trend panning out has only increased.
Yeah, and of course, you spoke about capital markets right at the beginning of the conversation. One of the things that some people are talking about is also how you can look at unloved themes which are starting to make a bit of a comeback. I was talking to Jakes earlier, this week, and for example, he was talking about how metals are making a bit of a comeback. Select pharmaceuticals could do well. Now, you have a really strong grip amongst many other things on how pharma, chemicals, etc. do. I heard you speak about chemicals. I haven't heard you speak about pharma as yet.
So, Neeraj, we are very, very underweight on pharma. And
underweight,
said that,
okay.
I think we are very underweight. We don't have much exposure to pharma. We have one intermediate manufacturer and one generic manufacturer, but overall weightage is much, much lower than it has been in the past. That is because, I don't feel a trend over here. There is a cyclical uptrend that is happening on the generic side, because the pendulum really moved the other way in terms of valuation, and also in terms of people basically gave up hope on the pharma sector. So some amount of rebound is absolutely possible, but again, that for us is a very, very tactical play, and we like to bet on themes and sectors that are more secular in nature.
Mm-hmm.
So in the past, I've bet and benefited from the pharma trend over a 10-15 year period. But going forward, I don't have the same kind of confidence on the US generic space. But the domestic space is still good.
Okay, but
that's a compounder that you can bet on.
But just the way you are speaking about it leads one to believe that that's not the pocket that you're really constructive about. Fair call. Sorry, did you want to make a point?
Yeah, no. Yes, we are. That's not the most exciting space for us, for sure.
I get the drift. Okay. Ravi, the other thing that a lot of people are now, of course, not just now, maybe talking about the last 2 or 3 years, but we've seen telltale signs of, again, the per capita moving up, and now the comparisons of what maybe global examples have thrown up in terms of countries moving from 2,000 to maybe 5,000, 8,000, what have you, come into play, and what they have done, and therefore what could happen in India. Now, my question to you is, are you kind of thinking about some of such pockets which might have a multi-year run? And certainly per capita moving up is looking like that. Do you look at that at all?
Right. So, we spoke about pharma. Pharma is a cyclical upturn, but the secular trend is missing. Consumer, on the other hand, is a secular turn, but the cycle is probably on its way down. So that is leading to some really interesting opportunities presenting itself in the consumption space. But I don't see in the next 1-2 quarter a major uptick happening from the cycle point of view. So I won't be surprised if they underperform for another 2-3 quarters. But having said that, I am very, very keen on picking up stakes in some of these consumer names where the valuations are cheap when you have a horizon of 5 years, 6 years, and not 6 months, 12 months. So it is a secular sector, and it excites us a lot. We are probably, still building up our position. We have placed some bets on maybe B2C consumer electricals. We have placed some bets on quick service restaurant, where some opportunity has arisen. But overall, from consumer point of view, I think there is still further scope for us to place some more bets, and we are likely to do that over the next 6 months.
Got it. Last couple of questions. One is on what has been the Pied Piper story of Indian capital markets for the world at large, which has been Indian IT, right? The poster boy, great governance, good growth, secular growth. COVID accelerated it. Right now, right at the opposite end of the spectrum in terms of favor as well as earnings growth. Is it a temporary pullback which at some point of time could come back? Are you positioned there, not positioned there? Why or why not?
So we are absolutely not in IT. We have almost negligible exposure to IT. and precisely because I believe that IT services as a sector is a slow grower. We have matured. I'm not saying, see, these companies are very good quality and the sector is not going anywhere. It is a evergreen sector, but I think you cannot expect to pay a 25-30 multiple in IT sector and make money. You will have to buy it when the margins are down, growth is down, and the valuation multiples are also lower than 20. And then you will probably get a 3-4 year cycle where you can hope to make good money. One such cycle just panned out because of COVID, and it happened to be much shorter than it usually is. It probably lasted less than 8 quarters. So that because that story is behind us, we are not very keen at this juncture. We will wait for time and a moment where the attractiveness of the sector becomes really, it's where if you do a reverse DCF, basically the growth that would be factored in, if it is less than 7-8%, that is where I think it excites us, because then you get the growth coming back from 7-8% to 10-12%, and the margins coming back, and some amount of re-rating also happening. So that's the playbook we have for the IT services. There are some other IT, maybe product, IT platform companies. Might be still some, there might be companies that can grow 25-30%. And that remains a space that we would be more than looking to participate in. So IT services as a space is not what excites us, but there are other IT related sectors that can be exciting.
Okay. My final question, and you correct me for, or excuse me for not knowing the exact status of that, but you guys have raised, I believe, or in the process of raising a reasonably large sum for a private fund as well. Now, tell us the rationale. Is it that the private markets are giving you opportunities that the public markets are not? And how do you see the progress of the private markets in India? Because we're starting to, in the last 3-4 years, starting to see private markets really come of age. Talk to us a bit about that.
No, so you're absolutely right. I think year 2021 provided fantastic exits to the private equity money. Now, it's stupid to have been on the side of providing the exit at that stage. However, I think in the life cycle development of the private equity in India, I think that was a very, very important challenge. As I mentioned earlier in the interview as well, if people have made money in this market, they will come back again. And that's precisely what has happened in the private equity. But the fundamental reason why we are looking, or you can say we are backward integrating into private equity, is because, see, the companies earlier used to go IPO when they were 200, 300, 400 crore revenue size. Nowadays, the companies go public when they are $1 billion, $2 billion kind of revenue size, or even bigger than that. So that tells you that companies, one, are reaching this kind of a stage earlier, sooner, because of the growth capital available in the private equity side. And those companies also are reaching in terms of maturity of the organization, corporate governance level, is also, they are reaching the stage far before they come to the public markets. So a lot of the alpha generation opportunity tends to get captured at an earlier stage. Our endeavor is to identify these companies maybe 1 or 2 stages before they go public, and that's where I think still a lot of opportunity is there. Now, we are not betting on loss-making technology or technology-enabled business models. We are betting on still pretty much brick and mortar or old economy, so to say, or solid business models that are making profits. So again, need to separate the private equity frenzy on the those cash burning business model versus the kind of businesses that we want to focus on. So I think that is the reason that those businesses are also will be IPO ready in next 2, 3, 4, 5 years, and we want to participate in them sooner than maybe a post IPO.
Well, we wish you all the best for that, and at some point of time we'll do a conversation separately on that. But for now, Ravi, thank you so much for your time today and giving us your thoughts. May the seat belts have to be kept fastened for a longer time. Thanks for your time today.
Thank you. Thank you so much.
And viewers, thanks
Pleasure.
for tuning into this edition of The Talking Point.